Okay, welcome to another video. This is a rundown of the top 5 charts of the week email. So this is the email that goes out to subscribers of the mail list on the website at topdowncharts.com. So we'll start straight into it, and the first one is the Fed and credit markets. So we've got here a chart of the Fed funds rate and US high yield credit spreads. And you can see there in the past that, once the Fed gets on with its hiking, even sometimes only a small hike, you often see a surge in credit spreads shortly thereafter. And sometimes it can take a while for that to flow through. Initially when the Fed was hiking rates in the mid-2000s, they hiked rates substantially, and it took a long time before that actually translated through into higher credit spreads. And a big reason behind that was because there was a housing bubble going on in the background, and it wasn't until the housing bubble rolled over that credit spreads began to widen. Similarly, more recently, in 2015, when the Fed hiked in December, it was around the same time as that was more of a commodities driven spread widening around that stage. But you can see there that, and it makes sense that you would see the credit spreads widen after substantial rate hikes, because, typically what happens is that if the Fed policy is, obviously it's countercyclical macroeconomic policy. So when you have a substantial tightening of monetary conditions, what that'll often end up doing is putting, companies with larger amounts of leverage under pressure, ultimately, as they refinance. And high yield credit, that's a lot of these borrowers do have, more credit, more leveraging than the others, and that's going to show through in a bit of stress in the sector. And then of course the business cycle aspect is that the Fed can ultimately end up crashing the business cycle or bringing it to an end. And obviously when the business cycle rolls over, when you're in a recession, default rates are going to naturally go up, because earnings come down, servicing becomes more difficult. And now that we're well progressed into the current tightening cycle, it is a matter of time, just a matter of time before credit spreads do widen again. I would say at the moment there's still probably some time to go before we do see rapid turnaround in that. Are starting to see a little bit of flare up and risk off at the moment, but we're certainly at the later end of things, and when credit spreads are this low, it's basically another way of saying that they're overvalued. So it's we can split here as about when spreads may widen, but personally I look at credit markets and think it's not a case of, it's not a case of do you own it or do not. It's more a case of are you neutral or are you short? And there's a few things to talk about on that, but I'll leave that for another time. TED spread number 2. So the initial widening that we saw in 2016, 2017, and this so it's a spread of interbank rates to treasuries, was down to the tax changes, sort of changes in market structure regulation. I wonder if that's still having an impact, but there's been a few other reasons put forward, such as repatriation of cash by corporates as the tax changes kick in. And there's just a sort of broader concern about whether this is a bit of credit risk. Back in 2012, that was actually a reflection of the Eurozone crisis and credit downgrade and all the rest of it. But in 2016, it was, there was nothing really going on then. As a matter of fact, 2015, 2016, when we saw those corrections, we didn't even really see much movement in this indicator at all. So, you know, there is a bit of debate about how useful this indicator is. Now it was, gained a lot of fame and popularity in the lead up to the financial crisis, as many people looked at this and used it as a good reason to get out. And so, in that respect, rightly or wrongly, people are still paying attention to it. And so, if you have a widening in this indicator, then that can be something that sort of has this reinforcing effect on the sort of risk-off episode that we're going through at the moment. And I was reflecting on that earlier today when I saw the dip down in the consumer confidence index, quite a substantial drop. The first reaction is to dismiss it because it's just related to the market turmoil, and it almost certainly is related to the market turmoil. But at this point in the cycle, when animal spirits are particularly important, that can actually have a negative sort of self-reinforcing downward spiral. I mean, if it can spiral up on the way up, then it can spiral down on the way down as well. So on that cheery note, we'll move on to the next one, which is emerging market import volumes. And this one is indeed a cheery note here. So we've got here, this is from the CPB. It's in, forget what it stands for. It's an organisation in the Netherlands. They track global trade. It's pretty good indicators here. And this showing you the volumes, so the trend in volumes for emerging markets. You can see there that during that 2014, 15, 16 period, emerging market import volumes are very much stagnant, almost recessionary. And then into 2016, 17, it had that synchronized upturn and quite a significant surge in imports, particularly into January, which was quite interesting. In terms of the drivers of that, a lot of it was emerging Asia, and so that's, i.e. China, but it was actually pretty broad-based, so LATAM and Middle East, Eastern Europe, etc., were North Africa, were pretty decent contributors to it as well. So, it goes to show that the global trade, synchronized global upturn in global trade is still in play. And that would probably surprise many people given some of the headlines that we've had around protectionism. Number 4 is a picture of US crude oil imports and production. So quite interesting longer term perspective chart here. So the first point to note is that, from the 1920s all the way up to the 1970s, crude oil imports were around 10% of, overall US oil supplies. So, and then it peaked at about 2/3 in here around the mid-2000s. As you could see there that US crude oil production slumped to what was about a 50-year low. And then more recently we've had that upturn, that surge there in US domestic oil production. That's primarily related to shale revolution, so big technological breakthrough there, which for commodity markets it's actually quite an interesting point that this chart raises, because the old paradigms, the old narratives can quickly get turned on their head, quickly get shattered by technological breakthroughs, because it's true that the overall stocks, the overall resources, for example, if you look at the agricultural example, arable land is certainly limited, but humanity's capacity for innovation and technological advancement is far from limited. So, if you're sitting there saying, well, I'm going to buy these commodities because, this supply is, irrevocably fixed, and, you might need to check that assumption, because while it may be true that demand is going to go up across time, it may not be the case that supply is as fixed as you thought, as oil markets found out, and as a result of that surge, that led to that commodity crash. But the other good thing about that surge is the big benefit to the MLP energy infrastructure sector has created a interesting setup for that industry where valuations are quite cheap at the moment. Talked a bit about that in that article, specifically about MLP, so if you want to have a look at that, go ahead. And the last one is the Euphoria Meter, and this is a funny little indicator that I've invented, and the point of it is to bring in different types of sentiment information. So we've got the forward PE ratio and the VIX, and these are basically market-based mechanisms of, or measures of, investor sentiment. The higher the PE ratio, the more optimistic investors are basically on the future earnings potential, and the lower it is, the more panic's in the market. And similar for the VIX, the lower the VIX is, the more complacent investors are, and the higher it is usually panic conditions. And then the Bulls line, which is in the dark line down the bottom there, that combines surveyed measures of investor sentiment. So you're bringing in a couple of different metrics, and you can see there that when it reaches those higher levels, it's more euphoric markets. It's actually quite interesting to note how extreme it got in the last couple of months, and that was almost as high as it got during the dot-com bubble, but has pulled significantly back in the last week, back to April 2017 levels. And there's a couple of things that we can sort of talk about there. I guess one interpretation is that this is a bear market signal, because when this indicator goes to an extreme and then rolls over, that's it typically takes quite a bit of time for that to play through. As you saw in 2015-16, took a while to ultimately make a big and significant reset there. Similarly, into the financial crisis, took quite a while to make that big reset. Same again after the dot-com bubble burst, again in 94 and 95, and in the early 90s as well. But then there have been a couple of times where you have had quite a substantial mid-cycle reset. So for example, just coming out of the financial crisis 2010, in the wake of the Eurozone crisis, debt downgrade again in the late 90s. So there's plenty of examples where it's not necessarily the end of the road, but certainly an interesting dynamic there going on in investor sentiment, something to keep in mind. Now, if you want to receive this report, this is something that I do on a weekly basis. So I'll go through various blogs, social media posts, and pick out some of the more interesting, more controversial, more meaningful charts, and pick out 5 and put them into your email box. So if you want to subscribe to that, just go to, we've got there, topdowncharts.com, and you'll be able to see a sign up box. Otherwise, I'll put one in the description of this video. If you've got any comments, suggestions, complaints, please put them in the comments section of the YouTube video. Otherwise, subscribe to the channel so you don't miss out on any future updates.